What's up, everybody? It's Finance CJ. Happy Finance Friday, and thank you for joining me for episode 9 of my channel and episode 2 of Why Pick a Winner. Today we're going to be talking about the retail sector, and I know what you may be thinking, that the retail sector has been one that has been taking a beating over the last year, but I'm going to talk about some stocks that have progressed through last year and even shown some great earnings last year. The stocks we're going to be talking about are none other than Walmart, Target, Home Depot, and Lowe's. All four of these companies have progressed through the pandemic and even shown better earnings than the year before. That's because they had more foot traffic because other things were closed down. And now with everyone stuck at home, everyone wants to work on their home, and that's why they're flocking to Home Depot and Lowe's. Now, before we start the video, I'm going to be referencing some stats from the previous video, so if you haven't checked that one out, be sure to check it out above, below, and at the end. That video covers my first episode in Why Pick a Winner, so I hope you check it out, give it a comment, give it a like, subscribe to the channel if you haven't already, and hit the notification bell. We're going to be talking about 3 of the 4 statistics I talked about in my previous video, and that is net income, net revenue, free cash flow. The fourth that we're going to be talking about in this video is payout ratio. Now, the reason we're talking about payout ratio is because these retail stocks that I'm going to be talking about are major dividend payers, and the payout ratio makes sure that you as a shareholder know that they have enough cash on hand to pay you. The reason I'm not talking about operating margin is because that is more of a capital light statistic, and with these businesses we know they're very capital heavy. They depend on selling goods which they have to purchase to sell to consumers, and so the margin's not really going to tell us much. So instead I'm going to talk about payout ratio because it means more for us to look at if these companies can continue to pay a dividend in the future going forward. Lastly, before we get into the basket, I just want to remind everyone that I am not a financial advisor. This is not financial advice, and I encourage you to do your own research before investing. Now let's get into it. The first stock I'm going to talk about is Walmart, and the second is Target. These two are direct competitors, so they go hand in hand. So I'm going to talk about them, then I'm going to talk about Home Depot and Lowe's. Just like last week, let's take a look at the numbers together, and then I'll break them down for you. So again, we're going to be comparing 2020 Q3 and 2019 Q3 earnings numbers, and we're going to see how they differ, if they're better or worse. Walmart's net revenue in 2020 Q3 was $134.7 billion, up from 2019 $126.9 billion. Their net income $5.135 billion, up from $3.288 billion in 2019. Their payout ratio sits about 31%. Their free cash flow is about $16.4 billion, and just one additional thing I want to talk about is e-commerce is up 79% for Walmart. So let's look at Walmart's direct competitor Target in 2020 Q3. Net revenue of about $22.3 billion, up from $17 billion. Net income at about $1.014 billion, up from about $750 million. Payout ratio of 39%, and a free cash flow of $5.996 billion. And digital comparable sales up 155%. Now, the major thing we want to talk about here is that both Walmart and Target saw an opportunity to expand digital sales, expand their online presence, and fight off the likes of Amazon. We saw this with Target, where they would let you order online and you could pick up same day. Walmart started doing this as well, and Walmart even started a subscription program to combat Amazon in the same sort of Prime style. Both these companies have been growing over the past year, and they did gain a lot of business from the pandemic, but they are both solid foundation companies. They have a small payout ratio, which means they can continue to grow the dividend to support their stockholders. They continue to grow their free cash flow and have more cash on hand so they can make strategic acquisitions and improve their business model. Because these businesses are so well managed, they make a cornerstone for a basket and a portfolio. They are the types of things that you can put in your portfolio for passive income and not really have to worry about the share price going down, because you know they are so well run and they are going to adapt to whatever life throws at them, including a pandemic. They are as close to a recession-proof stock as you're going to get. Next, we're going to talk about 2 more businesses that caught tailwinds on another end during 2020. That's going to be Home Depot and Lowe's. These companies were able to grow because people were staying at home and they saw every little thing that they wanted to fix while they were stuck at home. Now, Home Depot and Lowe's both saw growth over this time in their income. Their revenue, however, is a different story, and we'll talk about why that is. So let's go through the numbers again. Home Depot for 2020 Q3 had a net revenue of $33.536 billion, as opposed from 2019, $27.223 billion, a net income of $3.432 billion, as opposed from 2019 of $2.769 billion, a payout ratio of 52%, and a free cash flow of $14.652 billion. Lowe's had a net revenue of $22.309 billion, as opposed to 2019 $17.388 billion, a net income of $692 million, down from 2019 Q3 of $1.049 billion. Now, before we say anything, I want to clear up why they had a drop in net income. They did a massive debt payoff in Q3. They paid off debt before they had to, just to make sure that they had open credit lines in case they needed to take out more credit. Now, this is the only reason we're seeing a decline in net income, and in my opinion, this is not a bad thing for shareholders. The payout ratio for Lowe's is 32%. Free cash flow is $8.249 billion. The latter half of the basket, we're talking about more home improvement stocks. And both of these companies have showed that throughout the Amazon encroachment, they have been able to last through. Now, people are spending more time revamping their home, and even in my example, the room we're in right now is still incomplete, and I am still working to redo this room. But people are still spending a ton of money on revamping their homes, and with more people buying homes, they're more likely to spend more money to fix up a new home and make it their own, and that's why these companies are going to continue to get more business. For both these companies, nothing really scares me. The only thing that is a little concerning for me that I would say is a yellow flag is Home Depot's payout ratio. It's at about 52%, while you see everything else in the 30s. Now, as long as that continues to stay at 52% or even drop with some growth, I don't see it as a problem for shareholders to worry about. I think they can continue to increase their dividend, and as long as it's not going above 60 to 65%, there's no concern for me. And Lowe's is a smaller company compared to Home Depot, but they did the right thing and did some debt payoff, and I think this company will continue to grow. And even though all four companies are direct competitors to the other, I think that there is more than enough market share for both companies to survive the other. And I also think that people have their own niches, meaning that they would prefer to go to Target over Walmart or Lowe's over Home Depot and vice versa. So people are going to continue to have that brand loyalty. I know that people tend to get lost in the red dot of Target for some reason. And I believe that these are just companies that you should own in your portfolio, especially because of how good they are with their dividends for their shareholders. Now, all these companies pay a dividend, and they pay a healthy dividend, and the company is not at risk for paying that dividend. These are all wonderful signs for shareholders, as they can continue to put their money in there, and they can continue to see a return on their money, which will help their portfolio in the long run. As always, let me know what you think in the comments below. Let me know if you own any of these, and let me know if you're going to look into any of these. I am still working on this basket idea, so if you have any companies that you want me to take a look at, or if you have an idea for a basket that you want me to review, I'd be more than happy to. Just let me know down below in the comments. Don't forget to like, comment, subscribe, and hit the notification bell if you want to know when my videos are posted. And I hope you enjoyed the content. And until next time, happy Finance Friday. Good night, guys.